In his famous book, The Intelligent Investor, the father of value investing explained how buying stocks below their intrinsic value can produce high returns for investors. And value investing is a time tested strategy that has proven to be reliable over the decades. The most famous value investor today is probably Warren Buffett. Over the last 5 years, his company Berkshire Hathaway has returned 111%. That's a 16% annualized rate of return, which is pretty good and maybe not surprisingly outperformed the broad market. Value stocks are thought to trade below what they're really worth, and that's why they should provide a superior return over time. But one staunch criticism of value investing is that it tends to ignore the growth factor, and value investors will therefore miss out on less established but faster growing companies. These types of stocks have higher growth potential than value stocks and are assumed to also outperform the market over time. But because their valuations are typically quite high, it's hard for value investors to find any value in these stocks, especially when there's so much uncertainty, volatility, and risk associated with them. And unfortunately for these investors, it means that they could be missing out. The NASDAQ Composite is an index that has a lot of growth stocks in it, and it's returned 156% over the same 5-year period. Now, what if you can combine these two investing strategies? Use value investing to buy stocks at a discount, but also benefit from the faster growth potential of higher compounding businesses. Well, this hybrid investing strategy does exist, and it's called GARP investing. I have been actively using this strategy in my own portfolio over the last 5 years, and here are my returns. By utilizing elements from both value and growth strategies, my internal rate of return was 182% over the last 5 years. So in this video, I'm going to explain what GARP investing is, how it works, what are your options to invest using this GARP method if you want to, and share my thoughts on some GARP stocks so you can get a feel of how to analyze companies from a GARP investing angle. And hopefully this will help you make more informed decisions with your own money. Welcome back to the channel, folks. It's Liquid here. And to be fair, GARP investing isn't the only strategy I'm doing in my portfolio, but it has greatly affected my performance. So let's get into it. GARP is an acronym that stands for Growth at a Reasonable Price. And in a nutshell, you can think of it kind of as value investing with a heavy growth tilt. Value investors usually go for a low PE ratio. So if a price to earnings ratio is in the low teens or even single digits, that's an indication that the company is trading at a fair or cheap value. Meanwhile, growth oriented investors tend to hunt for the next Amazon or Facebook or Shopify. These companies tend to have above average growth in their industry, but they almost never trade at a fair PE multiple. And that's why GARP investors often have to dig a little deeper and look at something called the PEG ratio, or the price to earnings divided by the company's growth. And the faster the growth, or the bigger the number in the denominator, the lower the number is for the PEG ratio, and this is what you want to be looking for. For GARP investing, you typically want to find a company that is trading below 2 PEG, 1 PEG if you're lucky and if you can find it. And if a high growth stock is trading at a PEG ratio of 0.5 or lower, then that's like a screaming buy. So the best time to actually be a GARP investor is right now when we have compressed multiples, especially in the growth companies. So if you want to try your hand at GARP investing, where's a good place to start? Well, luckily, there's an index that tracks the performance of established stocks with GARP characteristics. It's aptly called the S&P 500 GARP Index, which is a basket of roughly 80 companies within the S&P 500 that have relatively high growth as well as reasonable valuations. And to get exposure to this index, you can buy the Invesco S&P 500 GARP ETF. This fund is put out by the same company that offers QQQ, which tracks the NASDAQ 100. So what are the differences between the GARP index and the regular S&P 500? Well, to start, there are no energy, real estate, utilities, or material sectors in the GARP index, which kind of makes sense. You wouldn't expect companies in these sectors to grow particularly fast on a consistent basis. So with fewer sectors in the GARP index, you'll have a more concentrated portfolio, particularly in healthcare, which makes up 30% of the index compared to just 13% in the regular S&P 500. Financials are also higher at 18% compared to 11.5%. But I was surprised to find that information technology is actually lower. It makes up 20% of the GARP index, whereas it's 28% for the broader index. You'll also have fewer communication services and consumer staple stocks in the GARP index, as those sectors tend to be lower growth. So, if you want to allocate a part of your portfolio to GARP investing, this is the easiest method. Just buy the SPGP ETF and you're good to go. According to the fund's website, it has a PE ratio of 17.2 right now, which is reasonable given that it invests in primarily high growth companies. And it has an expense ratio of 0.36%, which of course is the annual cost to hold this ETF. Now, what if you like to analyze individual stocks like myself and explore opportunities on your own rather than using some criteria by the S&P committee? Well, you can do that, and you can start with a stock screener. Like, I assume that's how most people get ideas for buying stocks because there are thousands out there. So, a stock screener can really help you narrow down your options. Now, there are default GARP stock screeners out there, or you can create one on your own using any platform you like. This example here, I'm looking at Fidelity. So it uses this filter inspired by Peter Lynch, and it looks at both growth and value at the same time. So stocks have to be above a certain EPS growth rate, quarter over quarter, year over year, etc. The PE ratio can't be over 15, and the PEG ratio can't be over 1. And this is just for, this particular screener, but you can update the numbers and change it however you want to get different results. In this case, it seems like there are 37 stocks that meet these criteria. It ranks these companies by score, which is nice. Although you still have to be careful and just look through any company in depth that you are looking at. Don't just rely on these screeners to give you recommendation and then go out and buy them. So CF Industries, let's take a look at what this company is. I like to use Yahoo Finance to just quickly get a feel for what a stock does, what its finances are like. So already I'm not liking this stock right now, just not anything about the stock, but just for the price. So let's move on to the next one, Western Digital. They make hard drives. And let's take a look at this. So no target estimate for this. 5-year chart, not looking too good, basically down from 5 years ago. The PE ratio is really low though, but it might be low for a reason. Let's go to the financials. Yeah, top line, you do not want to see that. So that is a no buy from me. I would not look at this company any further because its revenues or sales is basically dropping. Let's look at the earnings per share. Yeah, so there's a couple of negative figures in here, which means the company was basically losing money during those 2 years. It's not necessarily true for cash flow. That's a different statement, but just in terms of how much they were earning, it's negative, and that's not what I want to see. Let's move on to the next one. Micron Technology. I believe they are a chip manufacturer. They make memory chips. Analysts think it'll go to 112 a year from now. Stock looks pretty good. It's trending up. It doesn't have to, be a straight line or anything, but as long as it's good to see that it's up, quite a lot from 5 years ago. Let's take a look at the financials. Okay, 30 billion and then 23, 21, 27 and then 29. So not as bad as Western Digital, but not great. Diluted EPS, yeah, not too good either, but at least, they're still profitable every year. So, because the PE ratio is fairly low, I think this is worth a second look. So I would say Micron Technology passes the first test. For the second level of analysis, I like to use Morningstar and Refinitiv stock reports. If you're with any major bank like TD or RBC or CIBC, and you have a brokerage account with them, you should have access to these reports. I'll look at the Refinitiv report first. And for the target price, it doesn't look too good. Out of 35 analysts, the lowest 12-month price target is $77, which is pretty much flat from what it is today at $78. So if that person happens to be right, then this stock is not really worth holding. And then in the same report, looking at some valuation metrics, the price to sales is still above the 5-year average. So this is not a cheap company. Trailing PE is low, but it looks like at one point it fell to below 5. That's a little concerning because it did come back from that, but maybe next time it won't. At 5 times earnings, there's usually something off with the company. Now, moving on to Morningstar's quant report, this gives us a longer time horizon to analyze the company's finances. So the revenue is growing from 10 years ago. That's looking good. But in 2019, it started to fall. Diluted earnings per share, a little bit all over the place. I mean, last year it was basically making less than 2018 and a little bit more than 2017. And finally, looking at return on invested capital, again, it's all over the place. So that probably explains why the inconsistent PE ratio, price fluctuation, and all of that is just not a very high quality company because it doesn't have that consistent top line and earnings growth that I personally like to look for when I invest in companies. But who knows? The microchip manufacturing industry is likely to expand over time, and we're going to need more supply of memory. In fact, there's rumors that in the future we can have microchips implanted directly into our brain. I don't know why you would do that, but I guess you can say it's something to keep in mind. So there's certainly potential there for Micron technology, but right now, this is a great example of a GARP stock that I do not want to buy, especially at this price at this time. Now, let's talk about a couple of stocks I do like for GARP investing, which are Meta and Adobe. Both of these stocks are in the S&P 500 GARP index. Now, in last week's video, I took a few minutes to break down Meta, why I think the valuation is cheap, why I bought it, how much I bought. So I'm going to link to that over here for those who haven't seen it yet. And for now, I'm going to jump into Adobe. So this company makes software for content creators. I've been using Adobe Photoshop for over 10 years. It has a line of great products and has a very lucrative business model. So looking at the financials, that's really good revenue growth. In 2018, it made 9 billion, and the year after that, 11 billion, and then 12, 15, 16 billion in the last 12 months. Earnings per share, so this is the bottom line, what the company kept in profit after expenses, $5 per share in 2018, and then $6 the next year, and then $10. So very nice growth. Uh, that's the growth part of it. I'm in TD Web Broker right now to evaluate what about the price, right? Because GARP stands for growth at a reasonable price. So we've established Adobe is a growth company, but is it at a reasonable price right now? And that's going to change over time. So let's look at a Refinitiv valuation report from Thomson Reuters. And if I go down here to analysts, price target, today's price is 431, and out of 26 analysts, the lowest price target is 455. So that's pretty good. Even if the most bearish analyst is correct, you're still going to make money a year from now. And most analysts are pretty bullish about the stock. It's nice to see there are no sells or strong sells. So Adobe right now is trading at below its 5-year average price to sales. Not too much lower, but lower than average. Also, the trailing PE is also down 43 instead of its usual 53 times, which is very high. Forward PE looks pretty good. Again, below that 5-year average line. Let's look at this report over here, which is the valuations report. And it gives us an indication of what the stock has done in the past and how it might perform in the future. So the annual EPS trend, these solid blue bars, tells us what happened before. Nice growth there. And then these white bars on the right, these are what the expected profits are going to be for Adobe. So in 2024, it's expected to make $18 per share compared to $12 per share just last year. So that's a 50% increase in just 3 years, which is very nice to see. but is it at a reasonable price? This is the historic PE. I'm going to look at the blue line here, which is the trailing 4 quarters. And it looks like it fluctuates somewhere between, call it 35 times to 55 times in between there. So the average is about 45, somewhere here, if you were to average this blue line here in a straight line. And right now, it does seem to be, like fairly low. And this tells us it's trading at 26.8 times next year's earnings, which is for a fast growing company like Adobe, that is not expensive at all. So is it at a reasonable price? And is it growing? Yes and yes. So I would say Adobe today is a buy. It's not a strong buy because the valuation isn't really low. Like if the PE ratio today was at like 30 or below 30, I would say it's a strong buy, but it's not there yet. So what I'm doing is start a partial position in Adobe, and for me, that just means 10 shares. So I'm going to jump into IB and share with you how I'm going to do that. Okay, so today is Friday, March the 25th, and I'm going to be using IB here to buy some shares of Adobe. The first thing you want to do is to look up the name of the company. So if I type in Adobe here and press enter, I can click on this symbol, and I have some different choices here. I can buy or sell the stock, the options, the warrants, which are kind of like options, but one difference is you can take ownership of stocks directly from the company instead of writing a contract with a third party, and in other structured products. So I'm going to go with the stock because I just want to buy the stock. And as soon as you select the ticker over here on the order entry form, it's going to populate whatever company you have selected. If you don't see this for some reason, just go to new window and order entry, and that should pop up right here or somewhere, and then you can drag it to wherever you like. So it's a very simple order entry form. What I want to do is buy, so I'm going to click on buy. This tells me how many shares I have already. I just have one. I just bought it a while ago, but I want to add 10 more shares to this. You can either use this and scroll up and down until you find something you like, or you can just type in the number here. So 10, this is the bid and ask. I want to choose limit instead of like market or some other option because I want to set my own limit basically. And for the price I wanted to buy it at, this is a pretty narrow spread. Between like 47 cents and 68 cents. If you want to figure out exactly what the middle point is, just hover your mouse over this mid and it'll tell you what that middle point is. So let's go for 428.5, which is just below the mid price of both of these. So there's the mid right there. You can also do that. And then from there, you can open it up and then choose, let's go with, well, now the bid has gone up. So wow, so high. Okay, 78, and click on submit to submit my order. And I'll just hit on transmit. Okay, so that's going to put in this order here with the details. Now, at any given point, if I want to, see how this is doing, I can just come back here and I can always change my price if I want to maybe fill it at a bit of a lower price. But right now, I'm just going to leave it as is.
A few minutes later.
Order filled.
Okay, it looks like that order was filled at 428.78. So if I go over to the trades tab, this shows me the completed trades from today. And I bought 10 shares of Adobe at this price, and I paid a commission of $1. So that's kind of like an introduction to GARP investing. And just one last point about Warren Buffett, I do have to give him credit. He was convinced by Charlie Munger to sort of switch over from just pure value investing to GARP investing over time. So over the later parts of his career, he did invest in growth companies as well, like Apple, for example. So that's just a reminder that there's always something new to learn. So we have to change and adapt and be open to new evidence when we see it. Much like how a growth stock gets better over time, an investor with a growth mindset will get smarter over time. Thanks a lot for watching, and I'll talk to you in the next one.